All right, let's take a quick look back at this day in history. Back in the year 2000, when Chevron, the second biggest U.S. oil company, agreed to buy the third largest, Texaco. The price tag, $45 billion in stock and assumed debt, and the intent, largely designed to give Chevron the size to better compete with bigger rivals like ExxonMobil, like Royal Dutch Shell, like BP Amoco, each the result of acquisitions themselves amid a persistent period of low oil prices that really did force a dramatic reshaping of the industry. Now, the stage for that was set back in 1997 and all the way into 1998 when Saudi Arabia engaged in this ill-fated competition with Venezuela for market share. Unfortunately, that saw OPEC as a whole lose control of the oil market, and that pushed down benchmark crude prices 60% over the year to less than $10 a barrel. That hobbled profits at oil and gas companies around the world and led the industry to beef up balance sheets so that they would have the money to pay for drilling new projects, mostly in those deep ocean waters off the Gulf of Mexico and off the coast of Brazil and West Africa. And the CEOs, they realized very quickly that buyouts, acquisitions would be the quickest way to do it. A wave of mergers followed, creating the era of what we now call the super majors. It was during this stretch from 1998 to the year 2000 when Exxon coupled with Mobil, BP bought Amoco, Total combined with Elf, and Chevron merged with Texaco. Shortly after that announcement, Phillips Petroleum bought refiner Tosco, and Valero Energy struck a deal for Ultramar. The Texaco deal at the time it was announced was the third largest oil and gas merger involving a U.S.-based producer, and up until last year remained Chevron's biggest completed deal. That company now entering a new chapter, or at least trying to, abandoning California state where it had been headquartered for more than 140 years and moving to Texas, all while trying to put the finishing touches on a $53 billion acquisition for Hess, a deal that has cleared key regulatory hurdles but is still being held up by legal arbitration involving its rivals ExxonMobil and CNOOC, rivals that claim a right of first refusal on Hess's biggest asset, that 30% stake in that massive oil field off the coast of Guyana. That case, Scarlett, now before the International Chamber of Commerce, and it won't likely be settled into the third quarter of next year.